Hello and welcome to another daily Forex market review. My name is Schimming, and this review is for Thursday, January 31st. Now, so far this year, in January, it's really been a year of the yen thus far. When I say that, what I mean is the yen pairs have been the ones that have been moving with the greatest range, producing the most identifiable entries and trending for the greatest period of time. The dollar has still, for the most part, been trending sideways and not producing the same results. To see that, all you have to do is look at the average daily trading range, and you can see that the pound yen and euro yen are outpacing the euro dollar and pound dollar by probably 40% greater trading range. That's a substantial opportunity for us as traders. Now, I've told you in previous conversations and reviews that our CCYX is a substantial tool and should be where you start out each day as a trader. This should be the first thing that you look at. Just as when you do a cross-currency analysis, you're looking and comparing one pair to another to see whether the base currency or quote currency is moving in the desired direction of your trade. The CCYX accomplishes this to a much greater degree because it's looking at every currency pair traded in the world's largest global liquidity pool. We also trade into that global liquidity pool via a direct ECN. My CCYX disassembles every currency pair, isolates the individual currencies, and then displays them so you can see each currency's strength and or weakness against the other currencies in the field. The most desirable situation is where you have something consistently trending up, some currencies consistently trending down, and sometimes some are fairly consistent sideways. What we seek to avoid are the days that we are less inclined to place trades is where there is no direction to the CCYX or the currencies inside the field, where we see them moving around very sloppily and we don't have very much separation, identifiable range of separation between the currencies. Now, in this particular view, this is looking at rollover from Wednesday into today. We actually have an example of both taking place. You can see on the left-hand side of the chart, we have a very sloppy view. We have currencies that start to move up or down, little sideways action. It kind of seems like they want to move up, then it kind of seems like they want to move down, and really no separation. You can see how all the currencies, as a matter of fact, look, if I look right here, even at the extremes, the CAD is only at a -20, the yen is at a +21. That's just not very much range. And if you look at those in the middle, let's come right about here, you look in the middle, the euro is at a +8, and the Aussie's at a -15. That is not very much range at all. So really we had a sideways market with none of the individual currencies getting into a trend one way or the other. That changed as we got into New York, and the New York market opened before it really got going, but you can see from the New York time frame on, if I put a crosshair on here, right about here at the noon GMT, you can see how the yen started trading down fairly consistently. The yen is in light blue. You can see that the dollar started trading down, not as much as the yen, but fairly consistent to the downside. And then to the upside, you see three currencies that are moving up. The CAD displayed in yellow, the New Zealand here displayed in gray, and then most importantly, the pound in pink. The pound has been moving to the upside, fairly consistent through the New York session and up to this point. Starting to level off a little bit, but it has been a consistent mover to the upside. Look in the middle. You have the euro in red, the Swiss in white, and the Aussie in orange, all moving just straight sideways. Aussie's at 5, the euro's at 3, and the Swiss is at 3. So we have very little activity out of the euro, the Swiss, or Aussie pairs. That makes them less desirable. Remember, as a currency trader, I want to team something that's moving up with another currency that's moving down. What's that bring me to be? What pair does that identify that I can trade? Well, largely, in fact, that says pound yen and pound dollar. And since the pound yen has been outpacing the pound dollar, hands down this year, that does make on the day the pound yen the most attractive pair. So let's take a look at the pound yen, and we'll also look at my scenario, what I think is setting up on the euro yen, discuss both and talk about the options you have available to you going forward, both tomorrow for non-farm payroll and next week as we move forward. This is looking at the pound yen since the start of the year. Now, you can see, and I've marked the resistance line that had been set up at about 144.30, 20, 25, 30 range. Well, we had top of the market, a little bit of a move just above that range back in early January. But for the most part, we've identified or have established a resistance line up here just above 144. You can also see at the lower end where I've marked support at just below 139.50, about 139.40 range, where we have support. A little bit above that back over here, depending on how you want to look at this move. And so as a trader, when I have a pair that's in a range bound mode, I want to short it, sell it off of the resistance line, what they say fade resistance, and you want to buy it off support. It becomes difficult as a trader because mentally we think just the opposite. It gets to the top of the move and you want to take it, you think it's a breakout, oh I gotta go, and you got to really trade under breakout rules and be careful when something's at the top of its range, such as the pound yen is right now. But if you look at it, the consolidation yesterday, on the video yesterday, I even suggested, I said you got to err on the side of caution here because it would be more attractive, and you've got to consider fading this off of resistance if we see yen strength and it fails to get above the 144.20, 30 range. But that's exactly what it has done. It's moved above that range. So then I told you yesterday, and I'll say it again, breakout rules apply. When I say breakout rules, what creates resistance? It's a collision of buyers and sellers. We have sellers up there. We have buyers up. The buyers are driving it up. And the sellers are keeping it from going any further. Now that we've moved above that range, it says, hey, the buyers are winning this war. The buyers are pushing it higher. It's breaking above resistance. So our breakout rules apply. And when I say that, what I mean is we have to prove, we have to see proof that what was resistance is now support. There's only one way for that to happen. We need a pullback. We need a pullback. This thing has gotten up to 145. We need a pullback back into the mid 144 range or somewhere, some type of pullback. The better, the bigger, the better, as long as it does not break that resistance line. We'd like, if it wanted to fade all the way back to 144.30 or 20, I'd be happy. Probably can't come that far if there's this much buying activity, but that's what we want to see. So let's look at that on a little bit more detail. That's stepping it back pretty broad. Let's look at the pound yen over the last week. And here I have the pivots put on here. I don't have the resistance line drawn, but again, you can see this 144 level. Consider where R1 is today. It's at 144.40. So that really is pretty much our resistance line, and you can see how the pair has traded above that. Now yesterday it was consolidating just under that resistance line, and we had divergence. So it was my thought process that I need to be cautious if it's going to go any further than this, and I thought, hey, this would be ideal to see some yen strength and see it trade down, but it could break above. Well, it's broken above, so now it's the pullback that we want to see. This gives us a tremendous opportunity. As a matter of fact, when handled right, a breakout can be one of your highest probable situations. When handled incorrectly, however, it becomes a 50-50 dice roll, and something that many of you lose money on. When we look at the euro yen, let's jump over there. We look at the euro yen, and I'll do the same thing. Let's go back to the start of the year, and I've taken the liberty of putting a trend channel on here. And you can see the consolidation. You can go back 6 months on the euro yen and still see a chart that looks very similar to this. Because the euro yen for the past 6 months and more has been trading higher and higher and higher, setting higher highs and higher lows with consolidations. It moves up, pulls back and consolidates, moves up, pulls back and consolidates, moves up, pulls back and consolidates. It's been a tremendous opportunity. However, as the pound and the euro yen have been pushing to new territory, this becomes much less desirable to see the long trade on the euro yen. The difference is the pound yen had obvious resistance that it's breaking above, and again, we can take a breakout play on that. On the euro yen, we would be breaking out of the trend channel, and that gets into some frightening territory. It would be ideal to see this pair trade down. When I say that, and I've marked the previous low at about mid-channel, that would take it down to about 121.50. Now I'm not saying it's going to drop from 124 to 121.50, but that is the range of opportunity if it started on a pullback. It would take yen strength to do that, but on a pullback scenario, fading back into the channel, even if it went mid-ship, you have an above average opportunity to capture pips. If it wanted to trade to the bottom of that trend channel, that's taking us all the way down to 119. So as we come from this consolidation at the start of the year, we consolidated mid-channel and went back up and set a new high here in mid-January. We pulled back and consolidated again and lifted and went up and set a new high. Now we've consolidated and pushed against that trend line, and that does become a little bit frightening territory. So what does that say to you? It says as a trader, I have an option here. I can look at and identify an above average trading opportunity regardless what the yen does. It has been the year of the yen. The yen pairs have been producing the best opportunities. And as a trader, I now have the ability to consider an above average trading opportunity regardless which way the yen goes. If I have a strong yen on my hands, then chances are the euro yen would make an above average shorting opportunity with some range. If I have a weak yen, then that pound yen could in fact maintain its breakout ability and give us an above average opportunity to trade it above 145 and beyond. So regardless what the yen does, you have a place to be, and one is superior to the other depending on the yen's direction. Of course, I need divergence between the currencies, but that gives me the opportunity I want to see as a trader. Now, what's that say overall? Beside the fact that the pound yen and the euro yen have been your best opportunities, for those who do and would prefer to only trade the dollar pairs, the same rules apply. Just don't think you're going to have the same pip opportunity, but that becomes a personal preference. So today, what has been the opportunity today? If I look at the marketplace on the day and looking at this four square pattern, I have the euro yen and euro dollar and euro yen on the left side, and pound dollar and pound yen on the right hand side. The market looks like it's moving up today, and it has been moving up. But looking at the CCYX, again, the pound's been the strongest mover to the upside. The euro hasn't been really moving today. So the pound yen and pound dollar have been your above average opportunities. It's just that the pound yen's getting into some pretty lofty territory, and a pullback would be most attractive. If we move to the downside, again, the euro yen and euro dollar will probably produce the better results. But as a trader, it's my job as a trader to anticipate what could happen and be able to react. But anticipating and predicting are two different things. I can anticipate and prefer one direction, but if it's moving the other, my choices are to either go with it or do nothing. You don't predict and act on it, because that's what gets us into trouble. Save the predicting for the weatherman and analysts. You as a trader just need to react to the reality of things. And today, as we move into non-farm payroll tomorrow, we've got some tremendous opportunities on our hands. And if we look back at previous and the most recent non-farm payroll reports, the yen pairs have actually been producing the best results from non-farm payroll. So going into tomorrow, regardless what happens, we've got a trade on our hands and something that can probably produce some pips. So that's it. Looking at the Forex market as we close out January and we head into the February time frame, with the non-farm payroll to be maybe our jump start as we go into next week. If you'd like more information, if you'd like to trade non-farm payroll with me or sit in our trade room and work with us on a daily basis, learn my breakout strategy and my proven range bar strategy, then just send me an email to DerekSchimming@gmail.com. It's on the top of this YouTube page, so just go ahead and send me an email and we'll send you an invite and let you come on the floor. Thank you for participating and listening to our daily market reviews. My name is Derek Schimming. You have a great day trading.